In a loan modification, oftentimes people ask me, will my interest rate be fixed? First of all, nobody knows for sure, nobody knows for certain. We don't have a crystal ball, we can't see into the future. But the high majority of loan modifications do have fixed interest rates. And the reason is because the banking industry back in 2006, 2007, 2008, leading up to that first mortgage meltdown, was giving many ARM loans. Okay, an ARM loan stands for ARM, adjustable rate mortgage, which means after a certain amount of a fixed period, typically 5 years, 7 years, or 10 years, the loan becomes adjustable. That adjustable rate is based on the market. So the adjustable rate yesterday could have been very cheap. Tomorrow, because Russia decided to invade Ukraine, you can see your interest rate goes up. So for me, I don't like being so susceptible to what's going on in the political or the financial arena. I like to have my interest rate fixed. So we always push for fixed interest rates on our loan modifications, but again, we don't know for certain until we see that final loan modification paperwork. The fixed rate modification is meant to be something that will keep you in the home and keep your payment affordable for the long haul, which is why you see banks moving more away from interest-only loans, moving away from adjustable rate mortgages. And from back in the day, many of you may remember what they called the pick-a-pay loan. A pick-a-pay loan was just a nasty loan. Unfortunately, at the time they were legal. Now, nobody gives them out as far as I know. I don't know if they're 100% illegal, meaning that they don't pass mustard in the financial and the lending world, but I have not seen a pick-a-pay loan in probably 12 or 13 years. The pick-a-pay loan was when they would give you 3 options. The highest option, the middle option, and the lowest option. The lowest option being something that wasn't even fully amortized, which means if you picked the lower option, they were adding money to your principal. And then the middle option was typically an interest only, and then the fully amortized payment was the highest option. Almost nobody ever paid the highest option. So if you're in a pick-a-pay loan, if you've been in a pick-a-pay loan for that long, which some people still are, you should go for a modification because the modification can get you into a fixed interest loan. And the same thing goes for adjustable rate loans. If you're in an adjustable rate loan and you don't like the idea of your payment adjusting over the next, the life of your loan could be 10, 20 more years, a modification is a way to get a fixed rate without losing the years that you've paid in. Remember, a refinance is going to give you a 30-year loan. A modification may just keep the existing term of your loan, so you're not going to lose all that money that you've paid into the loan, especially on the principal side. So the question is, will my interest rate be fixed in a loan modification? The answer is yes, it should be, but it's not guaranteed, and it's something you have to keep an eye on.